Thank you. Okay, folks, sorry, technology was glitchy. There are a couple of things on the syllabus that I did not get to that relate to the thing that hangs over all of your heads, which is grading. Can you hear me? Okay. And I didn't mention how I was going to grade you. And first, if you're here for an easy grade, I would suggest switching sections because all the corporate finance classes are covered by pretty much the same grade distribution. It's about 30 to 35% A's, about 55% B's, and 10% C's, D's, F's, etc. You can fail a class as an MBA, but you really have to try. Okay. I'd like everybody to get A's. I mean, I actually view a B on your part as a failure on my part, so it's kind of but with a class this size, 5% C's is still a lot of C's. So let me lay out what I will try to do to make it at least transparent to you as to how to get a good grade. 60% of the grade in this class comes from quizzes and exams. There'll be 3 quizzes, and the dates of the quizzes are on your calendar, so you put them down. The first 30 minutes of class. Okay? Now, if you look around you, you already can see that taking a quiz in this room with all of you here is a nightmare. It's just people are bumping into each other. So on the quiz dates, I've actually got 2 other rooms, and what will happen is about 150 of you will leave this room into one of those 2 other rooms. And I'll tell you before the quiz, obviously this is not random, so you don't get, so you'll have more room for the quiz. 30 minutes, it's open book, open notes, open calculators or open iPads, no open laptops yet. And if it ever became open laptop, you'll have to be terrified about the kinds of quizzes I can give you. Okay? But the open book, open notes, I have to be quite honest, is a delusion, because with 30 minutes, if you keep opening your book and opening your notes, that'll be 30 minutes of your time. So you still have to be well prepared. But it does mean I won't test you on equations. Do you remember? I don't care about, because you can always look up an equation. It's really about applying what we learn in this class. So 3 quizzes, 10% each, and a final exam, which I think is scheduled for the 17th, the Friday right at the end of so it's before the weekend, so you can get done with it sooner rather than later, which is 30%. Now, I could tell you can't miss a quiz, but that's silly. I mean, you will miss quizzes. Why? Because life gets in the way. You're going to get sick, your spouse gets sick, your dog gets sick, you have to travel for an interview, so I understand. So if you miss a quiz, here's what will happen. The 10% from that quiz will be moved to whatever is left in terms of exams for the rest of the class. Let me be clear. So if you miss the first quiz, that's 10%, right? I'll move that 10% to the second quiz, the third quiz, and the final. So the second quiz will now become 12.5. The third quiz will become 12.5. The final will become 35. If you miss the second quiz, the 10% will get moved to the third quiz and the final. If you miss the third quiz, it'll all be moved to the final. Sounds like a convoluted way to do it, right? You know what I'm trying to stop? Strategic quiz missing. What is that? Well, if you do really well on the first two quizzes, one very simple way to increase the weight on the quiz, if I'm not careful, is to miss the third quiz and say, look, I missed the third quiz, the first two quizzes are worth more. So I've been doing this a long time. So whatever trick you have in mind, I've already thought about the solution. So in this case, the quiz, so missing a quiz is not the end of the world. I'd like you to miss quizzes only for good reasons. And I've learned in this class that whatever I say, I have to be explicit about. So if you go to your syllabus, I've listed out good reasons. But I'll also be open about the fact that if you give me a good reason, I will trust you. So if you tell me the subway broke down, I'm not going to go to the MTA website and check to see whether the subway broke down. I'll just say, okay. So really, I'm going to give you a pass if you want to miss a quiz. But here's why I think you should take all three quizzes. If you take all three quizzes, here's the bonus you get. I will take only your two best quizzes and drop the third one. So basically, I'll weight the two quizzes that were better quizzes, which means if you get to the first quiz and you're not quite ready, I would still take it, because what's the worst that can happen? You get a 0, and if it's your worst quiz, I'm going to knock it out. So it's better to take a quiz than to miss it, but if you have to miss a quiz, it's not the end of the world, because I've already got probably 50 emails from people saying, I missed the first quiz, so don't freak out, it's okay. You know, you might have to go for I think a couple of people had to go to a wedding. Just go have fun, but come back. Okay? Just don't stay in the island wherever you've been, wherever you've gone. So basically, that's the quiz part. You're saying, what's the other 40% for? 10% of the 40% will be for a case. You're saying, no, Harvard case? No, this is a case I'm going to write. On what? I haven't decided yet. The case is always going to be a case about in the middle of your capital budgeting. And what I will do is come up with the facts of a case that I will make up. And I'll give you examples of things I've done. I did a Netflix studio. I just concocted the numbers for a Netflix studio that they're going to put in Mumbai and said, hey, how would you, and I give you another. So as a group, you will work on the case. You'll usually have a 2-week window. So basically, you'll get the case on a day, and you'll have 2 weeks later, and it'll apply what we do in the capital budgeting section. That's 10%. So now we're up to 70%. Now let's talk about the remaining 30%. I call this the project, and you will see very quickly why it is the project, because in a sense it's already started. And here's what we're going to do. You're going to create, if you haven't formed a group yet, okay, you're going to create a group of between 4 and 8 people. Okay? I would try to avoid the 8 simply because the logistics of meeting as 8 people is just nightmarish. Okay? But I'll let you, if you find a group of 8 people, you can, or 7 other people that you can really trust, I'm okay with that. I'd prefer the group be at least 4. Okay? And here's what this project is about. It's about taking real companies and taking them through the same process that I'm going to take Disney and Vale and Baidu and Deutsche Bank. So while I'm doing this in class, in parallel, you're going to be trying this on your company. Now, in terms of picking the company, every person picks a company. So you gain nothing by having a larger group. So if you have 6 people, you have 6 companies, 4 people, 4 companies, 8 people, 8 companies. I would like the companies in a group to share a theme. Notice what I said. I didn't say they have to be in the same sector. Share a theme. I'll give you an example. If you're going to be doing airline-related companies, I would say look at maybe United, maybe you could look at Singapore Air, you could look at Embraer, which supplies aircraft, and you could look at Travelocity because it makes its money from. So in a sense, when I say theme, the theme could be travel, it could be consumer products. In fact, there are people who pick Vice as a theme, and they take a casino stock, a tobacco stock, a cannabis stock. Hey, have fun. Basically, the themes are broad enough, and I would encourage you to have diversity across your groups. What does that mean? Have a small company and a large company, US company and an emerging market company. If you want to bring in a private company into the mix, you can, but then you better have access to the information in the private company. So at least for this project, I would encourage you to stay with public companies and have the team tie them together. There are two groups of companies I want you to avoid. One is money-losing companies that have never, these are and here's the reason. It's not because they're not interesting companies, but from a corporate finance standpoint, you're going to run out of steam really early. Think about why. What are the three big decisions that a companies make? The investment decision, the finance. So with your company, you're going to take it through the process of, is it making good investments? Should it borrow money? Should it pay dividends? Now, if you have a company that's not just losing money, but it's lost money forever, you can ask, is it taking good investments based on the money it's making? Obviously not, but you could paint a picture of how they could make money in the future, but then say, should they borrow money? The answer is, of course not. Should they pay dividends? No, your project is done. You think, this is good, let me pick a company like that. But you're not going to be able to apply the tools that we learned in the class. So pick a money-making company. It doesn't have to make much money. You can still pick high growth. You can pick Tesla because they made that glimmer of a profit. I don't believe for a moment that they actually made money. But to the extent that you believe them, you want to take Tesla, all the more power to you. So try to avoid money-losing companies. Also avoid financial service companies. They're boring. Boring, why? Because they're so incredibly constrained that you can't tell me what the optimal debt ratio for a bank is because the regulators are going to know that's not going to work. Your capital ratio is going to be too low. So avoid financial service companies and money-losing companies. You're saying that's taking a lot off. You have 39,000 companies to pick from. That's how many publicly traded non-financial service companies there were around the world. And that's just publicly traded. So basically, you have enough choice out there that you can't complain to me and say, you took away all my choices. You have enough companies to pick from, and try to pick a company early. Don't sit there like Hamlet. Get to the 18th, I can't pick just pick a damn company. Because it'll help you as we go through the weeks to actually apply things on that company. And if in week 8 you say, this is not working for me, you can change companies. And because you've done the work on this company, the learning that you can be transferred to any other company. So it's better to pick a company soon and change your mind than to not pick a company at all. Okay? So the first step is, of course, forming a group. And as I said, I will not put you in a group because I don't want to be responsible for the stuff that comes out of that. Right? So I'll let you pick the group. I'll let you police the group. If you have bad behavior, I know you have ways. You, after all, live in the city of the mob. Draw on the Sopranos. Figure something out to keep people in line. I do know there are people who will have trouble finding groups, either because they're Langone second years. Even they, if you hang around, how many people are already in a group? Okay, how many people are not in a group? Yeah, we have a couple of groups right here, so maybe after class you can create a first group. But I've also created what's called an orphan list. It's a Google shared spreadsheet. I will send you the link after class today. And if you're an orphan, you are rejected, repelled by every group you go to. It's a very pathetic group. So you don't, I know you don't want it to be public, but this is the only way to find a group, is put your name in the orphan list, and at some point in time there'll be enough orphans on the list that I will get you guys together. Right? This is like a match for people who have trouble matching. Right? So that's a desperation ploy. I will put the link up. You can put your name off, take it off as quickly as you want. I don't care. But you should be able to find a group and get started. The rest of this packet that you should have got the PDF or picked up on Monday describes what the project is about. I won't waste my time because here's what the project, it's about everything we do in the class. There are 10 parts of the project reflecting the 10 things we're going to do in the class. It's going to start by looking at corporate governance. Where does the power lie in my company? That's what corporate governance is. I'm going to do this for my 6 companies. You're going to do this on your company. And with each page, you'll also see data that you can pull off my website that might help you do your analysis. Spreadsheets that might help you on that part of the analysis. I also tell you whether this part of the project is more qualitative or quantitative. So you're not sitting there trying to find numbers for parts of the project where you will not be able to find numbers. Corporate governance, for instance, is predominantly subjective and qualitative. Other parts of the project might be more. So as you leaf through this, and as I said, I don't want to go through each page because it's not going to make much sense right now. You're essentially going to see the class play out on this project in each part of the project. I would like you to keep up with the project. You know what I mean by in week 1 when I do corporate governance, I'd like you to do, it's not going to happen. I'm a realist. Okay? So here's what I'm going to do every Thursday. Remember that project email? I'll nag you with a timeline. And here's what the timeline said. This is where you should be. And what I'm hoping is that some vestige of guilt will kick in and you say, oh my God, look at how far behind we are. It never works, but I keep trying. Okay? But every week I will nag you on this is where you should be on the project. I'll send you stuff that you can use to get caught up. But the more you can keep this going in conjunction with the class, it'll help you in 2 ways. One is it'll help you understand the mechanics of what we're doing and why we're doing it. And second, this is the best preparation you can have for the quizzes that are coming because it forces you to get your hands dirty and understand the models, the metrics, the mechanics of what we do in class. So, as I said, the project has already started. Start thinking about companies. If you haven't already picked a company, if you've already picked a company, get to work. Okay? Pull up the annual report. Start collecting the raw data. I'll send you some pages if you can get to a Bloomberg terminal that you can print off for your company that, and you can do it. Take 10 minutes for your company for the whole semester. That might be useful for you to summarize data. Bloomberg has no proprietary data. It's actually data that's in annual reports and financial statements, but it's actually nice and compact. So you can see 10 years of financials on one page. So I'll send you, the pages on Bloomberg that will allow you to print that off. Any questions on the project? The project is actually due on the last day of class at 5 p.m. But the numbers that you come up with on your project are due in the weekend before the last day of class. So I'll actually send you a spreadsheet saying, what did you find out about your company in terms of the hurdle rate, what's your optimal debt ratio, they're paying enough in dividends, what value do you come up for the company in a spread. And the very last class, actually I have nothing planned in terms of material. You know what you're going to see? You're going to see the summary of everything you found, because there are going to be 350 companies on which we have corporate financial analyses. You're going to see how many companies came out as under 11. So you're going to get to see your companies play out in terms of the distribution of what you find. Because one of the things that I hope you get out of this class is perspective. You know what I mean by that? If I tell you a company has no debt, your first reaction is, oh my God, that must be unusual. Or if I say it's 70% debt, is that a high number? The reality is most of us have no perspective on a number because it's not something we hang out with all the time. Even if you worked in a company, you saw the numbers for that company, but you don't see the distribution. And what I hope you will get out of looking at the 350 companies is what percentage of companies actually don't borrow money. Maybe that is the norm, not the exception. What percent of companies don't pay dividends? Maybe that is the norm rather than the exception. But to me, that's a critical part of this class is after this class, when somebody says, I have a 63% debt ratio, you should be able to say, that's a high number. And you'll base it on the fact that you've seen the distribution of payout ratios and dividend yields and debt ratios. And that's a useful skill to have as you work with numbers. So no questions on the project? Yes.
Good morning, I'm Danica. My question is, just for a little more clarification, what is the format exactly for this submission in terms of 4 people, 4 different companies?
Rather than tell you, if you go to the web page for the class, there's a link to projects. If you click on that link, it'll give you data for the project spreadsheets, and it'll also give you a link to past projects. So you can see, the bottom line is the format is all over the place, right? Some people use PowerPoint, some people use Microsoft Word. Okay? Here's what I'm looking for. I'm looking for you to analyze your company, and think of me as the CEO of your company, and on May 13th, you're sitting across a table from me and telling me what I do well, what I do badly, what I could do better, what I'm in a sense doing that is costing me. And you're doing it in the form of a narrative backed up by numbers. So this is strategy with teeth, right? So you're not just going to tell me, oh, grow bigger. You're just going to say you need to grow bigger because you have good projects, you're not reinvesting enough. Or you're not just showing shrink and break up because you're back. So in a sense, the numbers are the least important part of the project. Because I'm going to give you spreadsheets that are actually automated. That'll tell you what the optimal debt ratio, you enter 12 numbers for your company, say the optimal debt ratio of your company is 40%. And the reason I do that is the mechanics of what we do here are not complicated. I don't want you to reinvent the wheel and build spreadsheets from scratch. That's a waste of your time, it's a waste of my time. I need you to be able to take that 40% optimal and tell me why my optimal is 40%. And if I'm actually at a 15% debt ratio, what I should do to get to 40%. So the entire project is about taking the numbers you're going to get about it, and you're going to get a collection of numbers about a company. You're going to see me use those numbers to analyze my companies, and you're going to use the numbers in your company to tell a story. You're saying, what's the group part of it? Remember I asked you to pick diverse companies? So if you have 5 companies, you're going to find that one of your companies has an optimal debt ratio of 0. It shouldn't borrow money. And one has an optimal debt ratio of 50%. It's going to give you a way of saying, hey, this is why this company has a high debt ratio. It's a mature company in a developed market, and this is a young growth company that's not making much money. By looking across the companies, then you can give your narrative some heft. Okay? So if you pick 5 companies that all do the same thing, you can already see your narrative is going to get pretty boring, right? Everybody has a 40% debt ratio. What are you going to say now? Right? There's not much. So pick different companies because then your story will be more interesting to tell. Right? But that's the end game. The end game is not about can you estimate the cost of capital. That's easy. The end game is can you take that cost of capital, tell me what it means for me as a company and what I should do next in terms of investments in capital structure and dividend policy. Okay? So if you want, you can look at the sample projects, and the only thing I will plea with you on is I'll give you a page limit of, and you'll see the page limit is actually going to depend on how many companies you have in your group, obviously. But the absolute upper limit is 25 pages. Absolute upper limit. You know why? Because I don't want you to tell me how to estimate a beta. I know how to do that. I don't want you to tell me the mechanics of how you got from there to the cost of capital. We all should know how to do that. I want you to spend your project telling me what you're going to do with the numbers rather than how you came up with the numbers. There are some really great projects where the entire project was fit into 12 pages. Okay? And the reason I need some page constraints from you is I told you at the start of this class, I have 1,100 people in 3 classes, all of whom are turning in final projects on May 13th. And that is in collection probably 150 projects times 20, even at 20 pages, that's a lot of reading. And if I get tired, then I get crabby, and if I get crabby, the grades start to show it. So basically, it's for your own good. Keep it compact, keep it focused, and everything's going to work out. So don't worry, you will hear plenty about the project over the next 14 weeks. You'll hear more about the project, you'll be doing more. In fact, this will take up a big chunk of your time, but rather than view it as an intrusion on time you could be spending preparing for the quiz, think of it as doing double duty for you. You're finishing the project and getting ready for a quiz and learning this material in a way that will stick. Any other questions? One thing about the acoustics in this classroom, and perhaps 98% of other classrooms around the world, is architects who build classrooms think about acoustics going one way, which is, can you hear the instructor? They don't think about acoustics going the other way. So when you ask a question, especially if it's from the limited view seats, I might be able to hear the question, but the rest of the class will not. So I will try to remember to repeat your questions. I'll forget all the time. But if I forget, remind me, because if I don't repeat the question, especially for parts of the class that didn't hear the question, it's going to come like, what's he answering? So I'll try my best to do that. Any other questions? Okay, so we're going to jump into the first lecture note packet. If you didn't bring it, don't worry about it. It's get it as soon as you can. So if you remember what the first couple of sessions were going to be about, they were going to be about the objective of a firm. What are we trying to do? Incidentally, I hope you got the weekly puzzle thing that I sent out yesterday. Did you? Right? This is the Schumer-Sanders op-ed on buybacks. And buybacks are now this hotly debated topic. Are they good? Are they bad? Are they destroying America? Are they helping America? I think it's a little overwrought in general. But what I've done in the article is list out the implicit assumptions. And I want you to think about the implicit assumptions. The implicit assumptions in that article is first, investing is better than giving cash back. At least from the perspective of the economy and what's good for the economy, it's better if companies invest the cash they generate from operations back into the businesses than give it back to stockholders. That's the first assumption. I'm not saying it's good or bad, that's the assumption. Second, that when you buy back stock, last year there were $660 billion worth of stock buybacks just on the S&P 500 companies. So I want you to think about, where does that money go? When you buy back stock, obviously cash leaves the company, it goes into somebody's bank account, right? At least the people who sold their shares back. Because implicit in the article is also the assumption that cash used for buybacks, in a sense, disappears. That it's not going anywhere in the economy, or people are spending it on personal stuff. And the third assumption, and this is, I think, the one that we're going to deal with in the next couple of sessions, is we have lots of problems. Income inequality, especially the lowest level, wages are low. So the third part of the op-ed says, only companies that pay a wage that will be specified, $15 per employee, and have not laid off employees, will be allowed to buy back stock. Is it good to connect social policy to buybacks? And if the answer is yes, tell me why. And the answer is no, tell me what the consequences are, because, and don't even tell me, tell each other, because these are things that will come up during the course of this class, but they're things that will come up in every class, right? Because this is something you're going to see debated in the next presidential election probably. So use those, I won't give you an answer. So if you're expecting next Monday that, actually you might get an answer, because I'm going to do a post on dividends and buybacks tomorrow, but don't let that drive your decision. So that's my view. And I want to be very clear. I have my views, you should have yours. I don't want my views to be yours. But what do I care what you think? And why should you care what I think? So basically, you should care what I think about the project, because I'll grade you on it. But on these things, hey, we're all entitled to our opinion. So tomorrow I'm actually going to put up my blog post on dividends and buybacks using, again, perspective. You know what the perspective is going to be? I'm going to look at dividends and buybacks in different parts of the world. Because we think only U.S. companies buy back stock. You're going to be surprised at how much this phenomenon has started to spread around the world. I'm going to look at buybacks broken down by sector. What sectors are you seeing the buybacks at? And that's going to give you some clues as to why you're seeing so much in buybacks. And I'm going to give you a graph that shows you what's happened to buybacks over the last 30 years and what's happened to dividends over those same 30 years. And the graph is going to just kick you in the face in terms of the trend lines. And I want you to think about, what is it about the world that has caused the shift away from dividends to buybacks? And that will become a platform we talk about, the 12th to 13th session when we get to dividend policy, but you don't have to wait till there, because it is going to start to show up even earlier. So today and Monday, we're going to talk about the objective. And if you remember, the objective we said in corporate finance is to maximize the value of the business you're running. That's a loaded word, value. In fact, right after the class, or at least a half a dozen emails from people saying, could you be more specific about value? My response was, I have 15 more weeks. I'll get more specific as I go along. Because you're saying, what is value? Value is everything. Basically, it is, if you think mathematics, the present value of your future cash flows as a company. But if you think about what drives future cash flows, it's not just what business you're in, how good your products are, what your market potential is. It depends on if you feel that if you're a company that violates, societal norms and, you get punished because you have legal costs, that's going to be part of value as well. So value is kind of an all-encompassing term. So that's the good side of value. You know what the bad side of value is? Somebody's got to estimate it. So this is almost an unenforceable objective written as is, because if I let managers estimate the value of their firm and tell you what the value is, what are they going to tell you every year? Our value went up. So now we're faced with a pragmatic question. If we want to have corporate finance to have teeth, how do we take this concept of maximizing value and make it into something that we can actually enforce? And you're not going to like my end result, but you're going to see why I got there. First, when you think about maximizing the value of your business, remember your business is composed of both investments you've already made and growth assets. Remember yesterday we talked about that contrast? So I would like you to maximize the overall value of your business. But managers don't, and if you think about who funds the business, it's both lenders, who are bankers and bondholders, and equity investors. But who makes decisions in a company? Managers, right? Because especially if it's a publicly traded company, you and I as stockholders can't walk in and say, I'd like you to change the way you do this iPhone thing. We could, then nobody's going to listen to us. Managers. And who hires and fires managers? Who are managers? Stockholders. So in the real world, here's what tends to happen. If you're a manager, you say, I know my objective is maximizing value of the firm, but if I can keep stockholders happy, my job's going to be okay. So in the real world, here's what tends to happen. Rather than maximizing the value of the business, managers focus on maximizing the value for stockholders, saying lenders can take care of themselves. Already I've made an assumption about lenders protecting themselves. But we're still left with this term value. It's nebulous. I could hire McKinsey to come in and make McKinsey very rich if every company required a valuation every year. So I'm looking for something I can observe out there that is an estimate of value. That could be wrong, but it's an unbiased estimate. So if we have a publicly traded company, guess what I latch on to? I want to maximize stockholder wealth. I'm looking for something out there that tries to measure stockholder wealth. It could be wrong, but it's unbiased. What do I latch on to? I latch on to the market price. In the real world, here's what tends to happen. Rather than maximizing the value of the business, companies focus on maximizing stockholder wealth. And because stockholder wealth is so difficult to estimate, they tend to focus in on maximizing stock prices. So if you open some corporate finance books, actually start by saying the objective in corporate finance is to maximize stock prices. That's not true. It's only if you make those leaps that you end up with maximizing stock prices. But that is the objective that much of pragmatic corporate finance is built around. And now we're on some very dangerous ground. I'll come to the weaknesses of this objective, but before I do that, let me first dispense with the false arguments against us. The first is if you maximize stock prices, it must mean you don't care about your employees. I find this absurd. Is it possible that you have to choose between the two? Absolutely. But here's what I'd like you to do. Take the 100 companies that had the biggest increase in market value over the last 10 years, a market price, and the 10 companies that had the biggest drop in market price, and ask yourself, which of these groups of companies would I rather work at? This is a no-brainer. The reality is most companies that do well can afford to treat their employees well. Amazon was able to raise employee wages to $15. What was that? In October or November, I don't know how it's been carried out yet, but Amazon announced that employees would make $15 an hour. Why are they able to do that? When you're close to $1 trillion in market cap and the market loves you, you can afford to do that. Can you imagine if PG&E, and for those of you who've been reading about PG&E, this is the California utility that declared bankruptcy, came out tomorrow and said, we've decided to increase employee wages to $15 an hour. It's not going to fly. For the most part, when you look at stock price performance and how well employees are treated, companies where stock prices do well, employees tend to do much better, and companies, I'm not saying it's a perfect correlation, but it's a false choice. Do you want to maximize stock price or do you want to take care of your employees? If you don't take care of your stock price, you can't take care of your employees. The market ends up pushing your value down 90%. I promise you, your employees are going to feel the pain. You're also told that maximizing stock prices must mean you don't care about customers. Actually, I was about 20 years ago, I was asked to come in. This was in the Gap, actually had a lot of money to spend. And they ran this top management meeting, and they wanted people in different disciplines to come in and talk to them about what the Gap should do. So I had the singular misfortune of following the marketing guru to the podium. And the reason I say singular misfortune is the marketing guru got up to the front and he said, the objective of the Gap should be to maximize customer satisfaction. And I got up and said, that's the stupidest objective I've ever heard. Because let's think about you as a customer at the Gap and what drives your satisfaction. You walk in, it's a nice, well-lit store. Everything is neat. You're feeling pretty good. You walk over to the khaki section. They've got your size and exactly the shade of khaki you like. You pick it up. You're feeling even more satisfied. Your satisfaction is rising. Then you get ready to leave. And there's this crimp on your satisfaction called the cash register. Doesn't it make you feel a little less satisfied that you have to pay? You're saying, this is absurd. Hey, if my objective at the Gap was to maximize customer satisfaction, you know what I should do, right? Take the cash registers out. You'll have a lot of very satisfied customers, but 2 days later you'd be bankrupt. I know it sounds absurd, but the reality is maximizing customer satisfaction is an absurd objective. Do I want satisfied customers? Absolutely. But why do I want satisfied customers? Because I want them to come back and buy stuff from me. You're saying that is so mercenary. I am a business, not a charity. And this notion again that you're picking between customer satisfaction and stock price again strikes me as absurd. Take a look again at in fact, I'll send you the list of the 50 companies whose market value has gone up the most in the last 10 years and the 50 companies whose market values dropped the most in the last 10 years. It's easy to pull up. And you take a look at the top 50 and the bottom 50. And you ask yourself, which of these groups had more satisfied customers? It's almost a truism, right? How did you get to be in the top 50? Because you had people who liked your stuff and kept buying stuff from you. So this notion again, do you want to maximize stock price or do you want to take care of your customers, strikes me as a false choice. And then, of course, there's this third choice. Do you want to maximize stock price or do you want to take care of society? Now that's where we run it. I mean, that's become a hot topic of corporate social response. There are entire areas of business that have come up with this. I'll give you a sense of how people think about corporate finance, and it's based on stereotypes. And it comes from one of my favorite movies. It's called Other People's Money. I don't know whether you've ever seen it. It's an old movie. I'll send you the YouTube clips from it. It's a 1980s movie. It's a movie with Danny DeVito playing the role of a corporate raider, an activist who's taking over a company, and Gregory Peck playing the CEO of the company being taken over. So already you can see the stereotyping right there, right? There's Danny DeVito, corporate finance, short and crude. And here's Gregory Peck, the anti-corporate finance, tall, distinguished. Already we've set the stereotype up. But the reason I like this movie is it doesn't play entirely to stereotype. I'll tell you the story of the movie. You're saying, I wanted to watch the movie. I'm not giving away too much here. Gregory Peck runs his company. It's up in a New England town, a small town, and it makes phone cables, physical cables, in an age where people have started to shift towards fiber optics. So Gregory Peck doesn't like to fire people. He keeps making cables because that's what they've done. And he's targeted by Danny DeVito because the company is investing back in factories and nobody's buying the product. So that's the setup. And the climax of the movie is an annual meeting. You say, what kind of movie is this? Now, maybe they should have let Liam Neeson into that meeting and mowed down 100 people. But in the meeting, here's what the climactic moment is. First, Gregory Peck gets up there and he says, we have a social responsibility to preserve jobs and keep the factory open. And then Danny DeVito gets up and says, you think I'm shutting the factory down? It's fiber optics. Okay? I am just the messenger. You might view me as the messenger from hell, but if I don't do this, it's going to happen anyway. The point I'm trying to make is, if you want companies to be socially responsible, and everybody does, you've got to start with those companies being financially healthy. If you're not financially healthy, you can't afford to be charitable. I'll give you a personal anecdote to illustrate this. 4 kids, very different personalities. My oldest son, when he was young, used to be the most, what's the right word to use? Careful with his money. Okay. Not a sharer. So around his confirmation, I'm not Catholic, but my kids all went through confirmation. So he has confirmation, he has a party, and people start handing him envelopes. I didn't know this was part of a tradition. And the envelopes have money as gifts. So basically at the end of the confirmation, he collects all the money and he has $300. He turns to me and says, Dad, and he gives me $100. Go give this to the poor, as if I have some direct conduit to the poor, right? And so I said, Ryan, that's very generous of you. He said, I'm feeling rich, Dad. And in a sense, that cuts to the heart of when companies can be charitable. If you're feeling rich, like Microsoft was in 2002, you can say, we're going to put up computers in every library and we're going to do it for free. But if you're not doing well, and you're having trouble delivering profits and your stock price is down, can you imagine getting up there as HP in 2015 saying, we're going to give a computer. You're saying, no, keep the computers for yourself. You might go bankrupt at any moment, right? But this notion again that if you are practicing corporate finance, it must mean that you really don't care about society strikes me as a false choice. One of the things I'm going to talk about is the difference between an objective and a constraint. I want customers to be satisfied because it's a conduit for me to make more money. I want to keep society happy because I have interactions with society in the form of contracts I have to get. And can you imagine if you're viewed as a bad company, the consequences that come from that? If you want companies to be socially responsible, you've got to make it in their financial best interest to be so. And you know what that requires? That we all put our money where our mouth is. You want to make sure that people get paid $15 an hour. Well, stop buying stuff that was made by people who made $2 an hour, which might require that you pay a lot more. You want companies to be socially responsible. It has to start with you. You have to stop buying the products of companies that you feel are beyond the pale. You got to stop buying stock in companies. So in a sense, this means that ultimately everything will show up in the financials because that's the only way to make this stick. We can lecture companies about how good it is for them to be socially responsible, but at the end of the game, you know what that's going to mean? 50 pages in your annual report telling me how socially responsible. What a waste of paper. I mean, this is absurd. Because every company has now made its annual reports. Look how good we are. Look what we did in Africa. We gave this to the inner cities. Yeah? It's something we're going to have to talk about more openly because I think by letting corporate social responsibility take on the patina that it has, we've not asked the follow-up question of how do we bring that into the financial results and make companies accountable for being socially responsible. I'll tell you also, though, why stock prices have become such a convenient mechanism to focus corporate finance around. They're observable continuously. You see how much of an advantage there is? If you believe that stock prices are good reflectors of value, all I have to do is look at the stock price to tell you whether the action you just took was a good one or a bad one. You announce an acquisition, and you ask me, hey, you think that's a good idea? I look at the stock and say, your stock price just dropped 5%. I'm sorry, it's a bad idea. See how convenient this is? Because it means that the market then becomes the mechanism that delivers. So how much did Vale pay for being not responsible on 2 weeks ago when that dam that broke and hundreds of people have died? They lost $2.5 billion in market value over the 2.5 weeks. I know because I own Vale stock. And they deserved it. But if you have market price, it's observable. Every action, you can see the consequences. And there's a second part to this. If investors are rational, and I'm going to open that can of worms in the next session or two, if investors are rational, the price then becomes your best estimate of the value. Remember I said it doesn't have to be right, it just has to be an unbiased estimate of the value. In fact, we know markets make mistakes, but if those mistakes are random, the market price becomes your best estimate of value. So rather than ask you to go out and maximize something abstract, I can just say, hey, the markets can be wrong, but go out and maximize stock prices. And it's going to give us some great follow-up decisions on this is how you should pick projects, and this is how you should fund them, and this is how much you should pay in dividends. So I'll be honest, the reason we focus on stock price makes life easier for us as corporate finance practitioners to tell companies what to do. To kind of give you a sense of what we need to assume for stock price maximization to be the only objective you need as a company. I'm going to set up a framework that I'm going to continue to use over the next 2 sessions. The modern corporation is a web of conflicts of interest. Let's think about why. You have managers who run the company, right, who get money from stockholders and bondholders to fund the operations. I'm going to talk about 4 links. The first is the link between stockholders and managers. The second is the link between the firm and lenders to the firm, bondholders. The third is the link between firms and financial markets, because ultimately that's where your price is set. And finally, the link between firms and society. So I'm going to start off by describing the utopian world from which corporate finance is born. Already I've kind of given away what I think about the assumptions I'm just going to list, right? Because when did Utopia exist? It never did. Utopian world basically means I'm going to make some very unrealistic assumptions and I'm going to be open about it. This is where traditional corporate finance was born. These are the assumptions we make. First, we assume that stockholders have complete and absolute power over managers. You know how they exercise it? Through the board of directors, who in theory are supposed to watch out for stockholders, and through annual meetings where they can replace managers if they don't like them. So in theory, those mechanisms are so effective that managers basically do what's in the best interest of stockholders because otherwise they'll get fired. I told you it was patently unrealistic. Second, we're going to assume that lenders, when they lend money to a firm, even if they don't protect themselves, will never get ripped off. Why? Because they worry about reputation effects. Borrowers worry about reputation effects. So you lend money and you leave loopholes the size of a Mack truck. I don't drive my car through it. I say, look, I'm not going to exploit my lenders because I might have to go back to them 2 years, 5 years, 10 years down. So in this world, lenders lend money, they don't get ripped off. Third, in this world, firms reveal information about what's happening to them, to financial markets, honestly and on time. Utopia is a nice place to be. Honestly and on time. So bad things happen to you as a company, you run out to markets and say, guys, bad things are happening to me. I'll give you an example of how this would work out. I've been an Apple user since 1981. For a long time, Apple did not have a laptop. Late 80s, early 90s, they finally come up with what they called a laptop. It was like 15 pounds, it was hot as hell. Called the very first PowerBook. But we were glad. Finally, we had a laptop to call our own. It had one small problem. It sometimes caught fire. Now, this is not a feature you go looking for in a laptop, right? Spontaneous combustion, not in that one, not in that one. That one has it. I'll take it. Next presentation is going to be incredibly memorable, but your next plane ride is going to be a disaster. It turned out that the batteries that they were using overheated and sometimes caught fire. So in the world that I just described, what did Apple do the minute they found out? They run out to market and say, our laptops are hot. In fact, that's going to give you some insight into how companies lie. Technically, that is not a lie, right? When they say our laptop, you're thinking they're selling a lot. You're not thinking laptops are going up in flames. So let's get in the world that I described, they would go out and say, our laptops are catching fire. We want to let you know right away. Why? Because you need to adjust the price immediately. And in this particular utopian world, the market would be full of rational investors who take that information, process it, and then trade. Do you know what a trading room would look like in this world? It'd be full of polite intellectuals. That's a typical trading room, right? Basically would gather together and have this long debate about what this means for cash flows, growth, and risk. And finally, in this world, there are no social costs. You know what a social cost is, right? Any cost that you cannot trace and charge to the firm is a social cost. So you're saying pollution costs? Yeah, if I can trace pollution costs to you and charge you the cost, it's no longer a social cost. It becomes your cost. So the essence of a social cost are costs you create for society that cannot be traced and charged back to you. Again, I'll give you a very personal example of a social cost. I used to live in a town called Chatham, and I lived about a mile away from my daughter's school, which was, but on the roadway between my home and the school was Merck's headquarters. They had a big building, and you think, what's that got to do with social costs? Every morning when I drove my daughter to school was when Merck would open its gates and people would come in, and they'd create a traffic jam. So every morning they cost me 10 minutes of my time. Sounds like a pittance. First month I actually sent them a bill. I said, you know what? I know you want corporate finance to work, and I know you don't want to create social costs. This is how much it cost me, 220 minutes last month. Would you kindly deposit the money in my account? Yeah. Didn't work. What I'm trying to say is we think of bad companies as creating social costs and good companies as not. That is not true. Every business creates social costs. That hot dog stand outside creates a social cost. You know why? Because every day when I walk down that pathway, I've got to go 3 steps to the left and walk around it. If you think about the sum of the additional steps I've had to take over my lifetime, that's a social cost. But in the world that I just described, there are no social costs. Why? Because that's what economists do to get rid of problems. They assume them away. So in this world, the only way to maximize stock prices is to do what? Is to go out and do it the hard way. Build a factory, produce products and services that people need. So much work. But there are no shortcuts. So in this world, when you maximize stock prices, you're also maximizing value. And if we all lived in this world, we could stop right here and say, it's okay, maximizing stock prices is a great objective. But I don't know about you, but I don't live in this world. So let's look at the world as it exists. First, what did I assume? That managers have complete power over shareholders, right? Let's take each of these lengths and let's break out what the real world looks like. Let's start with managers and stockholders. In theory, you're right. Managers are hired and fired by shareholders, and in theory, the board of directors is supposed to keep an eye on managers to make sure they're acting in the stockholders' best interests, in theory. In practice, neither of those assumptions holds. So let's take the 2 mechanisms that I just described and talk about why they're not that effective at keeping managers in line. The 2 mechanisms I'm talking about are the annual meeting and the board of directors. Let's start with the annual meeting. How many people in this room own shares in publicly traded companies? Okay, quite a few. I'm surprised with your student loans that your portfolios will shrink, so maybe by the end of the day. How many people in this room, about 100 people put up their hands. How many people in this room have been to an annual meeting? Not bad, about 4. Notice my hand did not go up. I own shares in 53 companies. I've never been to an annual meeting. You think that is so passive of you. It doesn't make any economic sense for me. I own shares in Coca-Cola. So what do I have to do to go to an annual meeting? I've got to fly to Atlanta. Do you know how much it costs to fly? For some reason, the New York-Atlanta leg, if you don't fly Delta, I guess, is like $600. So $600 round trip. I have to stay in downtown Atlanta. The costs are mounting already. You know, those sections of desolate city where everybody seems to flee at 5:30. Probably cost me 2 nights of $200 a night, $1,000, and there goes my profit for the year. So for most of us, it makes no sense to go to the annual meeting because we don't own enough shares. You're saying, but what about those institutional investors who own millions of shares? I'll come to them. But let's stay with us. So it's true. I don't get to go to the meeting, the Coca-Cola meetings. But in theory, I should still be able to get to the meetings in absentia, right? So what do companies, they've done this for the longest time. It used to be, in the mail, but now it's online. What do companies do so that stockholders can be at meetings without actually being there? They send out proxies. It used to come in this fat envelope. And whenever you got that envelope, or I got the envelope, it was going in one of two places. If I was feeling socially conscious, it was the recycling. If it wasn't, the trash. You say, why don't you just open the envelope and look, what am I going to do? Because I see names of people, I don't recognize any of the names. So and it's not just me. You know that half of all proxies that are mailed out to stockholders never get returned? They go in the recycling or the trash. So let's stay with that. So when I throw that the envelope into recycling or trash, I own 1,000 shares, that's 1,000 votes, right? What happens to the votes that I just threw away? From a common sense perspective, what should happen to them? They should not be counted, right? Around the world, though, you know what happens to the votes of the proxies that don't get returned? They get counted as votes for incumbent managers. This is like having an election where the incumbent gets the votes of anybody who doesn't show up to vote. No U.S. incumbent would ever get to, in fact, you probably wouldn't even, I think less than 50% vote. You've already won the election. You don't even have to vote for yourself. This is a system tilted towards incumbents. And this is why when you have an annual meeting, the vote percentages are a little misleading. You know who Jamie Dimon is, right? He's emperor of J.P. Morgan. Calling him a CEO understates his power. He's an imperial CEO. He's like Caesar. Okay? So like Caesar about 6 years ago, he decides that Caesar doesn't share power with others. What is this sharing power thing? So he said, look, I'm the CEO of the company. I'm also going to chair the board that watches me. Let that kind of run around in your head to see how that works out. And of course, shareholders said, that's not a good idea, Jamie. This goes against corporate governance principles. You shouldn't be. And of course, this came up for a vote at the J.P. Morgan meeting. And Jamie Dimon won, if you can call this winning, because he got 60, at least the Wall Street Journal story said, he got 60, that 65% of the votes were in favor of Jamie Dimon becoming chairman of the board and 35% against. That's a pretty dominant win, right? 65 to 35. But what did I just say? Half of all the proxies. So basically, Jamie Dimon lost 35 to 15, but because he got the 50% counted as votes, it is very difficult. Not impossible. It's very difficult to win a vote against incumbent managers at an annual meeting. We'll talk about what activist investors have tried to do to try to tilt the balance, but even they have trouble winning at an annual meeting. You're saying, but what about those institutional investors? Vanguard, Fidelity, Janus, BlackRock. Let's face it, BlackRock, I think, owns the world. It's scary. You go to parts of the world, middle of Africa, you take the 10 biggest companies, you look at who the largest shareholders are, there's BlackRock. It's like, where's Waldo? Okay. You're saying they must do something, right? Institutional investors are sheep. And I use that word deliberately. They vote with incumbent managers 90, 92, 93, 94% of the time. For a couple of reasons. They don't like to rock the boat. And in some cases, they have their own conflicts of interest. If you're Fidelity and you're managing the pension. So you're saying, what about the Vanguards and the BlackRocks? they're too splintered, right? Vanguard owns stock in pretty much every company because it runs index funds. It doesn't have the time to stop and fight. So if you're expecting institutional investors to pick up the slack and ask tough questions, hey, you can give up on that as well. So in most cases, annual meetings don't accomplish much. And that's in the US. We at least have a chance. You try to go to European annual meeting, they're exquisitely well-mannered affairs. You drink your little wine and eat the canapes and whatever you do, and 2 days, and you don't raise any questions. That's not civilized. I still remember Claudia Tattinger, who was the CEO of Tattinger's, an old-time French luxury company. And there's this activist investor from the US called Asher Edelman who decided to buy shares in Tattinger to try to push for change. And it turned out that Tattinger's owned all these chateaus. The company owned the chateaus, and nobody knew who was living in the chateaus. Everybody did, but nobody mentioned it. So Asher Edelman gets up and says, well, I see that your company owns a lot of chateaus. Who lives in those chateaus? Claudia Tattinger refused to answer the question. At the end of the meeting, she had a Wall Street Journal interview, and she said, I felt ashamed for the shareholders that such a question would be asked of me. Now you can see why the French Revolution happened, right? So if you think meetings in the US don't accomplish much, meetings in Europe, you might eat a lot of neat appetizers and drink a lot of wine, but not even less. And God help you if you go to Asia. I don't even know what to call that annual meeting. In Japan, in fact, especially in the late 80s, you did these activist investors in the US who tried to take it, and they'd have these Yakuzas show up at meetings. And every time the investor would get up to talk, the Yakuza, they're like these Japanese gangs you can hire in mass. They would all get up and yell at the top of their lungs, so they'd drown you out. So if you're thinking about getting a vote against incumbent managers in the meeting, you better fight your way through the Yakuza crowd to get there. You're saying, what about the board of directors? Well, let's start with some facts. First, directors are well paid. In fact, the average director in 2010 for an S&P 500 company made about $212,000. I looked up that number this morning. It's now $275,000 to $300,000 a year. And that doesn't count the fact that you get pension and health care and all the neat stuff. It's amazing that you get pensions for being a director in many companies for an extended period. So they get paid well. They don't work very much. In fact, the average director in 2010 worked about 228 hours. They're not updating that number anymore, which is either a good thing or a bad thing. Maybe it tells me more about how little they're working. And that includes meeting time. So if you think directors are sitting there working out return on equity on projects before they show up in meetings, give up on it. Third, when they do meet, nothing good seems to come out of it. They just meet. And finally, in many companies, you look at the directors, many of them are CEOs of other companies. And the Wall Street Journal actually did an article on cross CEOs. Basically, the CEO of a company is the director in another company, and the CEO of that has come. Can you imagine how those meetings will go? Let's build on this theme. They're well paid, they don't work very much, and when they do meet, nothing good, nothing productive seems to come. Let's see where those directors come from. First, in most companies, notwithstanding the fact that there's a nominating committee and all that neat stuff, ultimately the CEO, in many companies, CEO just says, it used to be, CEO, I want these 11 people. Let's play a little game. Let's suppose you become the CEO of a company. You want to create a board of directors. And you have two choices, and you can decide which choice you're going to go. One is to pick the 9 most well-informed, intelligent people who know a lot about your business, will ask you tough questions and keep you on your toes. That's option 1. Here's your second option. You walk over to your country club, into the bar area. You'll find the 9 most sloshed people you can find. So would you like to be on my board? And ask yourself, which one of these choices is going to make your life easier? This might be a little unfair, but who cares? John Mack, when he became CEO of Morgan Stanley, the first 2 people he put on the board happened to be members of the country club he belonged to. I know that these were probably the 2 most intelligent people in the country club, or they're probably the 2 most drunk people in the country club. The reality is they handpick directors. Most directors don't own much equity, so their income comes from what? The income they get as directors. And as I said, some directors are themselves CEOs of other firms. Finally, the meetings themselves. Have you ever sat in this meeting where somebody brings the Robert's Rules of Orders book with them? We've never been in it. This is a devilish device. Basically, it means that nothing can be brought up that wasn't already planned. And guess who plans it? The CEO says, these are the 6 topics. You try to bring up a topic that it's off topic, that's ruled out of order. You can bring it up at the next meeting, maybe. Okay? Second, there is this push in boards to be a team player, and it's human nature. It's tough to be the outsider, to be the one guy who keeps saying no. It's so much easier to go with the crowd. That's why I think so much of the laws that have been written around corporate governance miss the boat. They think if you have independent directors, you're going to have independence in meetings. The reality, though, is when you have a meeting and everybody is agreeing on something, it's very difficult to disagree, especially if there's an authority figure in the room. And who's the person in the room who tends to know the most about the company? The CEO. So when the CEO says, we're going into China, there's the China card, and we're going to make a lot of money, your reaction is, you know your company, you know your products, you know China, maybe. Right? You know that Jack says, I heard this, I don't know whether it's true, that during Jack Welch's years at GE, there wasn't a single vote that the board took that was not unanimous. What does that tell you? Either Jack Welch was right all the time, or you had a board of directors that was a rubber stamp. And he's a legend. Imperial CEOs become legends. So I actually have a proposal that I think would make boards more effective. I don't think it has any chance of ever succeeding. And I actually borrowed this concept from the Catholic Church. And let's face it, they've been around a long time. They've developed their own device for keeping things. And this was actually something that the Catholic Church devised in the 1400s, I think. I might get the century wrong, but somewhere in that Middle Ages. It turned out that too many people were becoming saints. You know the process of a saint is, right? Somebody says so-and-so has a lot of miracles, moved to sainthood. And they discovered that people just... And the reason was the people pushing for sainthood were much more vested than people who are pushing gains, because you really didn't know this person in that part of the world and what the miracles were. So you know what the Catholic Church created to keep this process under control? The devil's advocate. It's a scary word, but it's actually an amazing concept. The job of the devil's advocate was actually when somebody said, hey, so-and-so has committed 7 miracles, the Catholic Church would hire the devil's advocate, give that person, it was usually a him, it was almost always a him, it was the 1400s, the resources to go research the miracles. So think of this as dual presentations. The saint guy does his PowerPoint slides. Miracle 1, Miracle 2, Miracle 3, Miracle 4, Miracle 5. Devil's advocate comes up with his PowerPoint slides. Not Miracle 1, not Miracle 2, not Miracle 3. Okay? It's a magical idea. So you know where I'm going, right? Why did I say people in the board tend to... He's the authority figure. So for every CEO, maybe we should create a counter CEO. The CEO hires a banker to say, this deal makes sense. A counter CEO is given the resources to actually hire people to look at the numbers and say, you know what, those numbers don't make sense. I know it's going to slow the process down, but is that a bad thing? Especially in these big decisions. As I said, there's zero chance of it happening, but something to think about. CEO, counter CEO. We can call him the devil's advocate if you want, no? Or the devil's CEO. Right? So I'm going to close today by looking at what happens when you let CEOs pick boards. And to back up how bad a board can be, I'm going to show you what I think is the worst board ever created at a large company in history. That's quite a challenge to win, right? Worse than the Enron board, worse than the Lehman board. This was the Disney board. Remember I said Disney is going to be my lab experiment? In 1997. You say, why are you going back to 97? Because that's when the board was that bad. In 97, you know who the CEO of Disney was? A guy called Michael Eisner. Guy with an ego so big, he could be in a big room by himself and it felt crowded. Okay? And this was the board of directors he put together. And I'll go through why I think this is the worst board ever. First, there are 17 people on this board. You're saying, so what? Try this as an experiment. After class today, get together as a group of 17 and decide where you're going to go for lunch. I will safely predict you will not eat today. You have 17 people sitting around a table. You know what's going to happen, right? Every person talks, end of the meeting. Nothing to say, right? It's too big a board. In fact, studies consistently show that once you get past 9 or 10 board members, you've hit that tipping point. Second, 8 of the 17 members were insiders. They either work for Disney or used to work for Disney. You see why this is a problem? If you have a board of directors that's supposed to keep an eye on the managers and half of the board is composed of managers, that makes it kind of tough. Strike 2. Who's the chairman of the board? Oh, it's Michael Eisner chairing the board that's watching over him. Now, if this were baseball, you've struck out. But this is such a bad board, I'll give them a 4th strike. Let's look at the outsiders. Maybe they're so good they make up for the rest of the bad stuff. Let's start at the top. Revetta F. Bowers. She was the principal of an elementary school in Los Angeles. You're saying, this is good. Somebody's around kids all the time. Disney's a kid-oriented company. Coincidentally or otherwise, she was the principal of the elementary school that Michael Eisner's kids went to. I'm sure it's pure coincidence. Okay. Let's keep going down. George Mitchell is checking for steroids. If you have no idea what I'm talking about, he's the MLB steroids guy. He was there, former senator, a distinguished. But let's keep going. Father Leo O'Donovan, president of Georgetown. Anybody who went to Georgetown here? It's good to have some religious influence on this Heathen board, right? But again, coincidentally, Michael Eisner's son went to Georgetown. He served on the Georgetown's board, and he'd made substantial contributions to Georgetown University. I'm not suggesting there's any quid quo pro, but it doesn't pass the smell test. But here's my most egregious example of conflict of interest. Owen E. Russell, attorney at law. You're saying, what do you have against lawyers? A lot, but this is not the forum for me to go into that. But this guy happened to be Michael Eisner's personal attorney. How the hell do you get away with this? So I'm going to put my lawyer on the board. He's an objective third person. It's nice to have your lawyer in the room all the time. Saying, don't answer that question, Mike. Take the 5th on that one, Mike. Right? But don't tell me that he's going to be an independent third person. And then you have Sidney Poitier, great actor. In fact, in 1997, he made the list of top 10 directors. He said, finally, we have a good one. He made the list of top 10 directors in terms of directors who missed the most meetings. So guess who's coming to dinners? Hey, guess who's not coming to the meeting today? And he was chair of the compensation committee. That's nice, not show up at meetings and decide how much to pay. This is a dysfunctional board. It's a rubber stamp board. You know what happens in your rubber stamp boards? You have no restraints on CEOs. Remember, even the very best CEOs have some bad impulses. And if nobody holds them back on them, those impulses are going to kick in. And I'll give you a couple of ways this played out in Disney. A little bit of history for Michael Eisner. Michael Eisner came to Disney in 1984 from Paramount. In 1984, Disney was in complete shambles. They were still living on the fumes from Walt Disney, who died 15 years ago. They hadn't had a hit in like 10 years, Fox and the Hound, the 70s or something. The company was just coming apart. So they tried to hire, at that time Paramount was a very successful movie company. So they went to Paramount, to Michael Eisner and said, would you like to come to Disney? He said, not really, but you make me CEO and you give me enough money, I'll come. And they said, yeah, we'll make you CEO and give you enough money. And he said, well, one more condition. If I come, I'm going to bring my personal assistant with me. You think, what's the big deal with a personal assistant? Before you had iPhones and iWatches and calendars, your personal assistant ran your life for you. They told you where you lived, who your wife was, when her birthday was. So basically, think of the personal assistant as an iPhone with all the information built in. He said, I can't leave without my personal assistant. I won't know where I live. But the personal assistant didn't want to leave Paramount. He said, this is a good gig. I don't want to go to that loser company. So to induce his personal assistant, a guy called Jeffrey Katzenberg, to come to Disney, he said, if you come to Disney, I'll make you the head of a division. Yeah, personal assistant to divisional head. He said, okay, that sounds good. And in true Eisner fashion, here's what he did. He took the division at Disney that he thought was going to crash and burn. And he said, you be the head of the division, Disney Animation. Because at that time, they hadn't made a hit in 12 years. Nobody wants to watch an animated movie anymore. And the rest, as they say, is movie history. Eisner comes in, and then you have the little... one more thing as a sweetener, to show you how much Eisner believed that this division... He says, if you come in as the head of the division, I'll give you 2% of the revenues of every movie you make in this division. So you have Little Mermaid. Can you imagine getting 2% of the revenues every time the sea witch opens her mouth? You wouldn't have to work a day in your life. You could live in a castle. So he gets hit after hit after hit. By 92, the animated movie business accounted for a third of the profits at Disney. Now, if this were a business case, you've hired this guy out of nowhere, who's never managed a division, you put him in charge of a division, he makes it the most successful division of the company. If this were a business case, what should happen to him? He should be kicked up the ranks and given more responsibilities. That thought never even crossed Eisner's mind. He said, we've got to get rid of this guy. You see why, right? Because he was afraid he was getting too close to the throne. So he went to the board of directors and said, you got to fire Katzenberg. Now, if you're a board of directors, and I come to you and say, fire the head of the most successful division, I'd assume you'd have some pushback, right? But this is the Disney board. He said, how quickly, Mike? Right away. And then one of the directors brings up this unpleasant fact, but you promised him 2% of the revenues and all the movies that he made in perpetuity. What should we do about this? Don't pay him. On what basis? I don't like him. The board went along. Katzenberg would have settled for $100 million as a lump sum. But Disney refused to pay him. He fought it out in court, won $250 million. Which he used as seed money to create, wrong company, close, DreamWorks. Now therein lies an answer to a question that might have puzzled. Have you ever watched these Shrek movies, how they get the digs into Disney movies? Like in the Shrek movie, Sleeping Beauty has an addiction problem. She takes too many opioids, she can't get up. Snow White hangs out with 7 short perverts in a hut. Okay? And if you're wondering what's going on here, that's the history. Disney versus DreamWorks playing out in Shrek movies. So go back and watch the Shrek movies. That's your assignment for the weekend. Okay? Okay. But I'll close with this. As all these stories came in, the Wall Street Journal would keep asking, how come the board of directors is letting this happen? And the answer was, hey, take a look at who's on the board. So here's my assignment for you. For your company, already you can see I've jumped ahead on the project. You say, haven't you thought about a company? I'm going to assume you have a company. I want you to just check out who's on the board of directors for your company. Do some due diligence. How many people is it in it? Basically saying, is this a rubber stamp board or is it the kind of board that will push back? And you're not going to be surprised at the results. So I will talk to you on Monday. Actually talk to you multiple times before Monday. Physically, I will talk to you on Monday.
Senior, I have senior such a cool jacket.
You like it?
Yeah. I saw this photo. You bought it.
This one is 950 euro. But with the tax. There's a tax, deduction.
After tax deduction.
It's like around 950. And in the US it's around, and that's around